Good morning and welcome to another edition of Bourdier's Monday Report. The trade war is back in the spotlight once again. At the end of last week, Donald Trump announced new tariffs on goods imported into the United States. In particular, goods from Switzerland will be subject to a rate of 39%, much higher than had been expected. The new taxes come into force this Thursday, 7th August. This is a heavy blow, but the story does not end here. The Federal Council will have to resume negotiations in the next few days, and this time it will have to be more convincing. The aim must be to bring this tax rate down to the level of the EU and Japan of 15%. Swiss companies, for their part, will have to adapt, look for new markets, and continue their efforts to innovate. They know how to do this, as shown by their resilience in the recent past, both during the COVID crisis and during the sharp appreciation of the Swiss franc. Furthermore, if needed, the excellent health of the Confederation public finances could enable politicians to take support measures to relieve the most penalized companies or sectors. We are not there yet, but it is reassuring to have some room for maneuver. Last week, the most important economic statistic published was the number of jobs created in the United States. The US economy created just 73,000 jobs, fewer than 104,000 expected. What's more, the figures for previous months have been revised downwards by a total of minus 258,000 compared with the initial publications. This means that the labor market is more fragile and less buoyant than expected. The risk of consumer disappointment, even before the impact of new custom duties, has therefore increased. The head of the BLS, the institute that publishes the employment report, has already paid the price. She has been sacked. What's more, despite pressure from Donald Trump, the US Federal Reserve kept its key rates unchanged last week. The decision was not taken unanimously. However, the institution as a whole considers that the level of price growth is still too high, above the 2% target, and that activity is still sufficient to be robust to take action. We will therefore have to wait for a further deterioration in the economic situation for it to lend its support and resume its interest rate cuts. With this rather negative news flow, it comes as no surprise that we have had a risk-off week on financial markets. Equities are down by 2.5% almost everywhere except in Switzerland, where the fall is more moderate at just 1%. However, this is due solely to the fact that the Swiss market was closed on Friday, 1st of August for the bank holidays. This morning, equities in Switzerland fell by around 1%, a fairly limited contraction. Sovereign 10-year yields have fallen by around 15 basis points in the US and 5 basis points in euro. As a result, bond prices have risen by 1.4% in dollars and 0.4% in euros. The dollar index rose sharply by 1.5%, but this did not prevent gold from gaining 0.5% over the week. The week ahead does not look to be very busy in terms of economic data releases. We will have the ISM Services Index and the trade balance in the United States, inflation for July in Eurozone, and the trade balance in China as in the US. Swiss assets and the Swiss franc are likely to suffer, at least temporarily, from the announcement of new US tariffs. One Swiss asset that we like and that has been spared by the trade war is real estate. It is also one of the winners from the easing of monetary policy by the Swiss National Bank and the maintenance of low interest rates. That's all for today. Thank you for your attention and see you next week.